Richard, over to you.
Can I get the slides up first?
I think she'll be.
Okay, there you go.
Well, the United States government almost shut down yesterday. And I think that's a symbolic of the fact that there's so many ideas about what is the right thing to do under the circumstances. There are people who are saying more fiscal stimulus, no, there should be less fiscal stimulus, more monetary stimulus, less monetary stimulus. Others are saying there should be more capital injections to the banks, no, they got already too much money. What to do with the rating agencies, all these debates that are happening in this country, in many European capitals. Well, we in Japan went through all of it, every single one during the last 15, 20 years. And it was a very difficult debate, same degree of confusion, same degree of confrontation, strongly held views, fighting each other. And it took us a long time to figure out that we're actually fighting a different disease. It's not an ordinary recession by any stretch of imagination. It's a recession that happens only after bursting of a nationwide asset price bubble financed with debt. So when something like that nationwide asset price bubble financed with debt does not happen very often. In fact, the last one of this magnitude was back 70 years ago, 80 years ago, the Great Depression. And once something like that bursts, asset prices collapse, liabilities remain, and private sector balance sheets, hundreds of them, millions of them, end up being underwater. And that changes the behavior of economic agents from the usual profit maximization to what I call debt minimization. Because if your balance is underwater, you cannot borrow. No one will lend you money. You have to regain your credibility at all cost. And that pushes the world from the so-called neoclassical economics where everybody's maximizing profits on the assumption that private sector has clean balance sheets to a world where private sector does not enjoy clean balance sheets, and people have to minimize debt in order to climb out of that predicament. Now, whenever I start saying that, well, so there's something to be learned from Japan, I usually get this really nasty reaction that says, what? We have something to learn from Japan? Forget it. The country did everything wrong. They're so slow, too little, too late, didn't recognize all the problem loans quickly enough in the banking system, the zombie companies, too slow with structural reform. Forget it. There's nothing to learn from Japan. Japan is a counterexample, perhaps, but not an example to follow. Well, against that, I usually start with this chart, which shows what happened to US house prices this time around, Case-Shiller index, against what happened to Japanese house prices exactly 15 years earlier in both Tokyo and Osaka areas. And as you can see, those two series have moved remarkably together. And usually after seeing this chart, even the loudest opponent typically becomes rather quiet. Says, maybe we were not that different after all. And against that, the central banks all over the world dropped rates very sharply, in the case of the United States, to the level of the Japanese rates. And the money supply was also increased dramatically. Money supply, the monetary base was increased dramatically. This is the US case where monetary base, the red line, was increased dramatically, QE1, QE2. But as you can see, money supply, the actual amount of money the private sector can use, did not grow at all, almost flat. And the green line, which is the credit available to the private sector, actually fell. And those three lines are supposed to move together. That's what we learned in schools, and that's the world we had before the crisis, three lines moving together. Same thing in Eurozone. ECB increased liquidity quite dramatically, but money supply grew very, very slowly. Same thing in the UK. In the case of the UK, if you remember that when Bank of England started this massive quantitative easing, the key line was that we're not going to be like the Japanese. We're going to increase the money supply, and we're going to get out of this recession very quickly. Well, look what happened to the UK money supply. Not growing at all. And real output, well, mentioned already, but unemployment in the United States still 8.8%. Eurozone only still 9.9%. This is with the lowest interest rates nearly in history. And with zero interest rates, we're supposed to be seeing 3 or 4 bubbles by now. But that's not what's happening. House prices are still falling in this country. Unemployment still at these very low levels. How do we get that? Well, we went through the same thing in Japan. And this is what happened to Japanese demand for funds during this period. From the bubble days, during the bubble days, as you can see, Japanese companies borrowed tons of money, investing in all sorts of assets, thinking that they're going to make tons of money. And because the economy was doing very well, Bank of Japan, the other line, raising short-term rates to as high as 8% when inflation rate was less than 2. And in 1990, the bubble burst, and you can see demand for funds falling very, very sharply. And Bank of Japan dropping rates from 8% to almost 0 by 1995. And look what happens afterwards. The demand for funds from the private sector actually goes into negative and stays negative for full 10 years. And they went into negative with zero interest rates because all the assets they bought during the bubble days collapsed in value, liabilities remain, and they realized that their balance sheet's underwater. They have to pay down debt to repair their balance sheets. Now, that's the right thing to do at the micro level, because if you're a corporate executive, you don't want to tell your bankers that, sorry, it's all non-performing loans. You don't want to tell your shareholders, sorry, it's all piece of paper now. And you don't want to tell your workers that you have no more jobs tomorrow. Even if you're bankrupt, if you have cash flow to pay down debt, you use the cash flow to pay down debt. And during this entire period, Japan was running one of the largest trade surpluses in the world. So there was nothing wrong with the Japanese cars and cameras. There were consumers all around the world who wanted to buy these products. So the Japanese companies had none of the structural problems in the sense of lousy technology or terrible workers. We had none of those problems, but the balance sheet was underwater. So everybody was using cash flow to pay down debt. Even though that's the right thing to do at the micro level, and this is, of course, what's happening all around the world today in both the United States and Europe. But when everybody does it all at the same time, we enter a fallacy of composition problems. And that is that in a national economy, if there's someone saving money or paying down debt, you better have someone on the other side borrowing and spending money to make sure that those saved funds are put back into the income stream. And in the between are the financial types who take the money from this group, give it to that group to make sure that this money is all invested. Well, if there's too many borrowers, rates are raised. Too few borrowers, rates are lowered. Make sure at the end of the day, the entire sum is borrowed and spent. But in the world, we have the circled area where private sector is paying down debt with zero interest rates. You bring rates down to 0, and people are still paying down debt. No one's borrowing money. And what happens under those circumstances? Well, if nothing is done to this situation, each year, the economy will lose demand equivalent to the savings, additional savings, plus the debt repayment. In the Japanese case, this is just the corporate debt repayment, which was, and in some of the bigger years, over 6% of Japan's GDP, 30 trillion yen a year. On top of that, we had household savings, and if that was 4% of Japan's GDP, we could have lost 10% of GDP every year in this situation, even with zero interest rates, because people with balance sheets underwater is not going to borrow money at any interest rates, and there won't be many lenders either, especially if the banks themselves have balance sheet problems, which is also the case at the moment. Then Japan could have fallen into a Great Depression type scenarios, because if you look at Great Depression from this perspective, that everybody was deleveraging, no one was borrowing money, you can explain how US lost 46% of its GDP in just 4 years, from 1929 to 1933. And we in Japan were really right next to that scenario, with companies paying down debt to the tune of 6% of GDP, household saving to the tune of 4% of GDP. We could have lost 10% of GDP every year. Well, then you look at the Japanese GDP against what happened to commercial real estate prices. You notice that Japanese GDP, both in nominal and real terms, never fell below the peak of the bubble for the entire 20-year period, even though our asset prices fell 87% from the peak nationwide. So just try to imagine Boston prices down 87, Manhattan down 87, Chicago down 87, San Francisco down 87. What kind of economy do you think you have left here? Or what kind of balance sheets will be left here? And the Japanese economy managed to maintain the GDP above the peak of the bubble for the entire 20-year period. How did we do that? Well, it's very simple. The government came in and borrowed that money and spent it. We were lucky to have liberal Democrats who were highly liberal with public spending. As soon as the economy began to weaken, they said, hey, let's build roads and bridges, thinking that pump priming would work. And they put in the pump priming, economy improved, but as soon as that was removed, the economy began to tank again. And why do we get this effect year after year after year? Well, if asset prices fall 87% from the peak, 1 or 2 years of debt repayment is not enough. It may take 5 years for some companies, it may take 10 for others. But as long as these companies have, or these private sector sources of cash flow, they will continue to do that. So each year the same thing happened. Each year the government came in and said, keep the economy going. And that's how we end up with this chart, which is known in Japan as alligator's mouth. You have huge increase in government spending, tax revenue falling. The gap between the two, of course, is the budget deficit. And if you add this budget deficit together for the period from 1990 to 2005, when the debt repayment finally stopped, it's 460 trillion yen, 92% of Japan's GDP. And that's how Japan's public debt grew so badly. But I would argue that this was a money very well spent, because try to imagine a counterfactual where this money was not spent. Then chances are high that Japan's GDP would have at least fallen to the level of probably before the bubble. And that would be this dotted line in this chart. It would have fallen far more than that if the Great Depression is any guide. But let's say it had fallen to the level before the bubble. Then it would have looked like this dotted red line. And if you measure the gap between the actual GDP over a 15-year period against this dotted red line, it's over 2,000 trillion. So basically, Japanese spent 460 trillion to buy the GDP equivalent to 2,000. And so it's a pretty good deal, I would think. And they were able to keep the GDP from falling, private sector had the income to pay down debt, and now I'm happy to tell you that Japanese corporate balance sheets are the cleanest in the world. Half of the Japanese listed companies have no effective debt, meaning that their financial holdings are bigger than their debt. And the number of companies with no debt whatsoever is the largest on record. So yes, finally the Japanese corporate balance sheets are repaired. Now it was a turn for the government to repair its balance sheet. But just as it was going to do that, Lehman shock hit, and as you can see, Japanese GDP fell again. But the point is that when you're in this type of recession, what I call balance sheet recession, where people are paying down debt to repair their balance sheets, you have to have fiscal stimulus in there because monetary policy, I'm afraid, is largely irrelevant. And of course, the world put in the fiscal stimulus in 2009, as mentioned in the previous session, and our world economy stabilized. But there were actually two parts to the Japanese lesson. The first part is use the fiscal stimulus, but the second part is that you have to maintain this fiscal stimulus until the private sector balance sheets are fully repaired. And if you see there are two bouts of negative growth in this thing, 1997 and 2001, both of them were triggered by premature fiscal consolidation. In the case of 1997, IMF, OECD, those people who know nothing about anything, told Japan that you have an aging population, you're building bridges to nowhere, why don't you cut? And I tried to convince the Prime Minister that, no, you don't cut now. If you cut, the whole thing will come crashing down. But I'm just a foreign economist sitting in Japan, and all these big shots from around the world told Japan to cut. Well, he did. We have 5 quarters of negative growth, complete breakdown in the banking system, and a budget deficit, instead of shrinking, massively increased. This is the budget deficit, the purple areas, and the tax receipts. And on both occasions, 1997 and 2001, tax receipts fell, budget deficit increased. This is with a huge cut in spending, huge increase in taxes. So when we are in this kind of situation where private sector is minimizing debt, it's crazy to cut budget deficit because it's not, I mean, anyone can try to cut budget deficit, but whether it succeeds or not is a completely different story. It will succeed if the private sector is there to borrow money that the government is not borrowing money. But if the private sector is not there to borrow money when the government is withdrawing, then the whole thing will come crashing down. And that's the experience we had in Japan 1997, 2001, and United States back in 1937. Well, how does the world look like from this perspective? Well, I only have 35 seconds. But this is the Spanish flow of funds, and I'm sure people, forget it. If I explain this, I won't have time. This is a summary of what I was trying to explain with the flow of funds, and that is that compared to the peak of the bubble, how much did private sector savings increase relative to government deficit? And as you can see, in almost all countries except Greece, private sector saving, the blue areas, increased dramatically more than the government increasing budget deficit, meaning that once the bubble burst, private sector in Spain, Ireland, United States, UK, everybody wanted to repair their balance sheets, deleveraging. And that economy weakened. Government was forced to put in the fiscal stimulus to stabilize the economies. But those budget deficits, in my view, even though they were large, they were not large enough to stabilize the economies. And as a result, we see 20% unemployment in Spain, Irish GDP down 20% from the peak. These are not very pretty numbers, but the EU is still trying to reduce budget deficit because apparently that's the only game in town. And I think that's what's making the situation worse and worse, because if the private sector is deleveraging at zero interest rates, that means private sector is very sick. And you're telling the sick person to go run for a marathon. And it just makes the person even sicker. And that's basically what's happening in large part of Europe. And I hope they learn from the Japanese experience not to cut budget deficit when the private sector is deleveraging. Now, for the United States, I'm happy to tell you that some policymakers are beginning to be aware of this danger. I had a chance to talk with Chairman Bernanke a month ago, Chairman Goolsbee of the CEA a month ago. Both of those gentlemen actually read my book, which I was very grateful. And they understand this risk, that this is no time to cut budget deficit. And Chairman Bernanke has been saying, and I actually testified with him at the Humphrey Hawkins testimony, July of last year. He was telling the Congress, and particularly the Republicans, that this is no time to cut budget deficit. You can have a long-term plan to reduce the budget deficit, but not cutting it right away, because he understood that the risk of fiscal consolidation during private sector deleveraging. And so those are encouraging signs for the United States, but I don't see Europeans understanding any of this at the moment, except Martin Wolf in the UK and a few others, but that's not where, unfortunately, the policymakers are going. And even in the United States, Chairman Bernanke might be aware of it, Chairman Goolsbee may be aware of it, but you know that the vast majority of people in this country are still not aware of it. And so there's still a danger that we make the same mistake again. Yes, last chart, oh, sorry. Oh, all those charts are gone, sorry. We have to realize that when the private sector is deleveraging, government has to be in there. And government should be deleveraging only after private sector has repaired its balance sheets, so that government fiscal consolidation will not bring the economies down. Thank you very much.
Okay, thank you very much, Richard.